Investors should brace themselves for a potentially turbulent autumn, as September, historically recognized as the harshest month for stocks dating back to 1928, often witnesses substantial losses on Wall Street, triggering what is known as a correction phase. While the NASDAQ and the S&P 500 had strong performances in the first half of the year, their momentum began to wane toward the end of August. Please make sure to subscribe to the channel and leave us a like below. Anthony Danier, the CEO of Webull, a commission-free trading platform, has pointed out significant risks that are adding pressure to the outlook for September. This period is typically the weakest for stocks, with seasonal patterns becoming a factor in an already tense market environment. Tech stocks, in particular, pose considerable threats, with some, like Nvidia and Tesla, sporting earnings valuations of 200 to 150 times their earnings. Given this, it wouldn't take much negative news to unsettle investors and trigger a potentially harsh sell-off this autumn. This concern is exacerbated by the fact that 7 tech giants, often referred to as the Magnificent Seven, make up 30% of the S&P 500's market value and a significant portion of the NASDAQ. Thus, the downside risks are increasing, and continued losses could potentially result in a wider market contagion this month. Notably, in August, this group comprising Amazon, Alphabet, Apple, Meta, Microsoft, Nvidia, and Tesla collectively faced a sell-off, resulting in a combined loss of $623 billion. This latest downturn follows a series of disappointing earnings reports, indicating that the tech rally has likely reached its peak, and the level of overvaluation in tech stocks is no longer sustainable. Additionally, rising bond yields and the Federal Reserve's ambiguity regarding interest rates have added to the uncertainty surrounding the U.S. economy. Just a few weeks ago, Fed Chair Jeremy Powell dismissed the notion of rate cuts and hinted at the possibility of further rate hikes by year-end. As we move forward, key economic indicators, including corporate data reports, Fed meetings, and retail sales will be updated, and experts anticipate that they will contribute to market volatility. Moreover, declining trading volumes suggest that investors are on edge as we progress through the rest of 2023. According to CFRA Chief Investment Strategist Sam Stovall, September historically poses a challenging landscape, and the track record of benchmark underperformance has led the firm to caution investors to prepare for lackluster results for both the S&P 500 and NASDAQ in the upcoming month. M. Stovall noted that markets are currently factoring in a 20% probability of the Federal Reserve raising interest rates at its September meeting. However, a more precise estimate suggests that the odds are closer to 51%, according to the CME's Equi-Do-Watch tool. While inflation has started to moderate, it remains persistent in certain critical sectors like food and energy. The U.S. Central Bank has been clear that the tightening cycle is not coming to an end just yet. The key concern now is how much further interest rates can rise before causing disruptions. The oil market is signaling that inflationary pressures are likely to persist. Recent price increases indicate a surge in inflation, partly due to Russia and OPEC, collectively reducing daily oil output by over 1.5 million barrels. Crude oil prices are expected to reach $100 per barrel as these nations seek greater control over the global oil market. On a domestic level, the U.S. government sold a significant portion of the nation's strategic oil reserves in 2022 to combat rising oil prices, resulting in dangerously low domestic inventories. Any disruptions, especially during an active hurricane season, could lead to outages and price spikes, which would complicate the Federal Reserve's efforts to combat inflation. Furthermore, the outlook for stocks is influenced by the inversion of the U.S. Treasury's yield curve, a trend that has been deteriorating since June. An inverted yield curve occurs when short-term bonds yield more than long-term bonds, and this development has raised concerns reminiscent of the conditions that preceded the 2008 financial crisis. In 2006, yield curves were inverted for a significant portion of the year, and long-term treasuries outperformed stocks in 2007, which was followed by the stock market crash and the onset of the Great Recession. The current economic landscape is marked by uncertainty regarding interest rates, persistent inflationary pressures, and concerns about the yield curve, all of which contribute to the complex outlook for stocks. The yield curve has been signaling potential economic troubles, and this particular inversion has been raising concerns about a looming recession for over a year, as pointed out by Russ Mould, the investment director at A.J. Bell. Prominent figures in the investment world have been making rather pessimistic statements about the stock market in recent weeks. Citigroup, for instance, predicted a potential 10% loss in the S&P 500 by the end of the quarter. Notable Wall Street strategists like Mike Wilson from Morgan Stanley and Marko Kolombovich from J.P. Morgan Chase have also shared bearish forecasts for September. More recently, Albert Edwards, chief global strategist at Societe Generale, highlighted the increasing number of bankruptcies as a potential catalyst for an impending downturn in the S&P 500. Edwards, an experienced analyst, noted that arguments downplaying the sensitivity of businesses to interest rate hikes don't necessarily apply to a large number of companies. On one hand, large corporations have been borrowing money through long-term bond issuance and investing it in short-term bonds with higher yields, allowing them to profit from the difference. Edwards estimates that large companies have boosted their profits by around 5% in the past year through this strategy. On the other hand, smaller firms have not had the same access to affordable long-term financing or the cash reserves to engage in similar strategies as their larger counterparts. Many investors point to the resilience of corporate profits as a sign that U.S. businesses are no longer adversely affected by high interest rates. However, this argument holds true primarily for the largest corporations, while the majority of companies face significant challenges. Edwards illustrated the impact of interest rates on various cohorts within the S&P 500. The top 150 companies, mega-caps, have been minimally affected by higher rates, while the next 600 firms have experienced a more substantial impact. The bottom 750 firms have seen their interest rates rise significantly, from around 4.5% to 6%. This rise in interest rates is reflected in the increasing number of bankruptcy filings in the latter half of the year, as noted by Edwards. In July, Chapter 11 bankruptcy filings shot up by 71% year over year, coinciding with a time when banks are becoming less willing to assist struggling firms. This surge in bankruptcy filings is concerning because small businesses, which make up a significant portion of job growth, could face financial distress in substantial numbers. If this trend continues, it could lead to a more rapid deterioration of the overall economy, impacting the earnings of larger companies that typically drive the performance of the S&P 500. Edwards warned that even large and mega-cap stocks might not be immune to the indirect recessionary effects of high interest rates. In essence, the situation in the smaller cap corporate sector could trigger a deep recession, as many economists have been cautioning. Several concerning factors are indicating potential trouble ahead for the economy. The Institute for Supply Management's Purchasing Managers Index, PMI, reports a contraction in manufacturing activity, signifying economic challenges. Additionally, the number of consumers falling behind on credit card, mortgage, and auto loan payments is on the rise across the nation. Ryan Rose, the Chief Investment Officer, CIO, of UBS Americas, points to emerging trends that suggest growing financial instability among consumers. He notes that consumer savings are decreasing significantly, while current spending levels are unsustainable in relation to incomes. This means that Americans may be forced to cut back on consumption during the fall and winter. Over 60% of the population currently lives paycheck to paycheck, with a significant portion of their income going toward essential expenses. Consumption, which contributes significantly to economic growth, is contracting in the face of these concerning indicators. Michael Burry, the renowned investor famous for correctly predicting the housing market collapse in 2008 as depicted in The Big Short, has placed substantial bets against the market. Recent filings with the Securities and Exchange Commission reveal that Burry has wagered over $1.6 billion on a Wall Street crash. He has made bearish bets against both the S&P 500 and the NASDAQ 100. Burry's firm, Scion Asset Management, has invested $806.6 million in put options, which grant the right to sell an asset at a specific price, against an S&P 500 tracking fund and $739 million in put options against a NASDAQ 100 tracking fund. In essence, more than 90% of his portfolio is dedicated to betting on a severe stock market downturn. These filings also reveal that Burry's firm has been divesting shares in several regional banks, including First Republic Bank, Huntington Bank, and Western Alliance, over the past few weeks. These moves indicate that insiders are becoming increasingly aware of systemic risks that could trigger a stock market crash in September. A combination of factors, including a contracting manufacturing sector, rising consumer debt, diminishing savings, and significant bets against the market by influential investors like Michael Burry, suggests an environment of increasing risk exposure. Those who underestimate these emerging threats could potentially face substantial losses in the coming months. The current atmosphere is marked by heightened volatility, and the realization of challenges within the U.S. economy could have significant consequences for the NASDAQ and the S&P 500.